Is it just a coincidence? Maybe. But why are Warren Buffett, Mark Zuckerberg, Jeff Bezos, and the Walmart family, the Walton family, why are they all starting to sell a lot of their stock? Let's jump in and take a look at it. But first, I want to thank this video sponsor, Chapter. Chapter is a Medicare advisor that puts your interest in front of the insurance companies that pay commissions to Medicare advisors. More about Chapter later in the video, but let's jump in. The first article I want to share with you is The Motley Fool, where they share that Warren Buffett sold over $143 billion worth of stocks in 2024, but his most recent $3 billion purchases sends a clear message to investors, and that clear message is he's selling a lot more than what he's buying. And the article says that that might be a warning sign. I agree that that might be a warning sign. Let's keep going, and then I'll share with you my thoughts, and more importantly, what it means to you and I, and what maybe we should consider doing. Okay, the BBC reports Jeff Bezos to sell another $5 billion of Amazon shares. That was in July of 2024. Fortune magazine reports that Mark Zuckerberg just cashed in another $153 million worth of Meta stock, adding to the whopping $2 billion in his stock sales this year. Okay, so before I jump in and say this is what I think of that and share more about what the Walton family is doing, I want to thank Chapter, who's a Medicare advisor that helps people make the right decision for them among all the alternatives that they have for both when they start Medicare and then when they look at what types of packages that you might want to add on and whether or not a Medicare Advantage plan makes sense for you. The reason I agreed to partner with Chapter is because they pledged to put your interest ahead of the insurance company's interest. And as you know, I'm a big fan of working with people that are fiduciaries to you 100% of the time, both for a financial advisor, but also for one of the biggest decisions that we make, which is Medicare. According to Fidelity, the average individual at 65 is looking at over $150,000 still in front of them in expenses that Medicare doesn't cover, and then in the cost of Medicare in the copay. So making good decisions on your Medicare choices is really, really important. You can call Chapter at this number here or go to this link here. Thank you, Chapter, for sponsoring this video. I'm proud to partner with you. Okay, let's jump on. We jump forward. We talked about Zuckerberg. We talked about Buffett. Now let's talk about the Walton family. The Walton family sells $1.5 billion of Walmart stock after it jumped. The family trust sold $8.82 billion at the end of last week as that article came out. And Walmart has outperformed its retail peers amid market share gains. Now, all of this was before the tariffs had been put in place. According to investing.com, and this is as of March 5th, 2025, the Walmart Walton Family Holdings Trust just sold another, in addition to that, what I just shared, $307.5 million. Okay, so what does all this mean? The reality is most of us don't have access to high-cost, high-powered financial advisors, investment pros. So one of the things we can look at is let's look at what investment pros are doing, and let's look at what families that have access to some of the smartest minds in the investing, in the wealth management field, what are they doing? Because they're being advised by people that we would all love to be able to work with and have manage and help us make good decisions, but we don't have access to those folks. You do have access to fiduciary financial advisors to help you directly. And I know that most of my audience is not going to pay the 1% that most fiduciary financial advisors charge. And for those folks, I recommend the software that I like. I don't like using Google Sheets. I don't like using Excel sheets. I think I think it's just too easy to make a mistake. So the software I like, I am an affiliate. If you use this link here, you'll be supporting the channel. It's Bolden, which used to be New Retirement. Okay, so we know what the families are doing. What does it mean to us? And first off, is the stock market cheap? And I can answer that question. I don't know what's going to happen. I don't know if the stock market's going to crash. I don't know if we're heading into a recession. But I do know that the stock market is not cheap by almost any measure. And two of the measures that I like and many professional investors like to use. The first one was developed by Professor Robert Schiller of Yale University. And his is called the CAPE ratio, the cyclically adjusted PE ratio. And the PE ratio is just how much are people willing to pay for $1 of earnings from a company. And it's called cyclically adjusted because it's over a 10-year period as opposed to it'll bounce around on a daily, weekly, monthly, and even yearly basis. So the Schiller ratio uses a 10-year average. And we can see here that the 10-year average is right at 1.5 to 2 times standard deviations above the historical norm. And the other ratio I like to use is what Warren Buffett himself uses. It's one of the indicators he's talked about, which is what the street has called the Buffett indicator. And the Buffett indicator is essentially you look at the stock market value divided by that country's gross domestic product. And in this case, they're using the total U.S. stock market value, and this is as of May of 2024. And you can see that ratio is about 200%, 197%. And you can see that this ratio also is about 2 standard deviations above the historical norm. And I do want to thank current market valuations for the data on both of this. So what do we do? For most of us, it's going to be time in the market as opposed to trying to time the market. So should we be panicking? Should we be selling now? No, I never think that that's a good idea. But what I do think is a good idea is to have a long-term stock allocation. What percent of your portfolios in stocks? What percent of your portfolios in bonds? And sticking with that over the long term. Now, the last 2 years, 2023, 2024 were very strong years in the stock market. From October of 2022, which was the lows of that correction, to October of 2024 highs, the market, the S&P 500, was up 60%. That's a very strong move. Now, as I record this, yes, the market has pulled back from its highs, but not that much. And it's a lot easier to get back to your long-term asset allocation when the market is at or near all-time highs than it is once there's been a major correction. And unfortunately, when there is a correction, it tends to happen quickly. The saying in my industry is Wall Street takes the escalator up, but it takes the elevator down. Actually, the saying is it jumps out the window. And what that means is that downward move in the market can happen very quickly. So if you've gotten over allocated to stocks versus your long-term asset allocation, this would be a great time to look at that. This is not financial advice. I don't know your situation, but I do know making good decisions is important. And you want to make this decision when the weather is calm and you're thinking clearly. You don't want to be trying to make important decisions at a moment where it feels very scary, at a moment where, you know, layoffs are increasing, and God forbid if you were to lose your job and the market was down, that would be a really scary time, and it would be hard to make good decisions in that point. But hopefully you're not in that situation now, and you can think clearly, what should your long-term asset allocation be? And make sure that you're there so that you can weather a storm if a storm comes. Thanks for watching this video. YouTube says that you'll like this next video of mine. Take a look at it. Let me know if they're right. And thanks for watching this one. Thanks again to Chapter for sponsoring this video. Bye-bye.